Okay, so this is the question we're looking at. A Zambian manufacturing company is considering investing in machinery worth 7.1 million kwacha to produce a soft drink called JOBA with a market life of 4 years. The production variable costs are 6 kwacha per unit, and other overhead variable costs are 2 kwacha per unit. The annual incremental fixed costs are 1.65 million. The total scrap value of the machinery is estimated to be 3 million after tax at the end of the year. The company expects to produce 300,000 units per year. The estimated selling price of JOBA is 25 kwacha per unit. The selling price and the variable expenses are expected to increase annually by 8% and 6%, respectively, starting from the second year. Okay. So, colleagues, here we're dealing with part B of this question. Okay. We have to calculate the NPV of the project. Now, before we calculate the NPV of the project, which is the net present value of the project, we need to establish the cash flows that we're going to discount. Because remember, in the net present value technique, money in the future, you need to discount it into today's value. So that money which you're going to receive in the future, which will be the profits from this information, basically. The profits which we're going to receive in the future, we need to discount them into today's value. All right, so we need to make a marginal costing profit statement. All right, so remember, colleagues, any figure that looks funny, it has come from the question, okay? Nowhere else, the question, okay? So before we also make this marginal costing profit statement, we need to make certain adjustments because we've been told the selling price and the variable expenses expected to increase by 6% respectively, starting from the second year. Okay. So we need to get these new selling prices and variable costs. Okay. So this is how I'm going to get the new selling prices. Okay, so you're just going to say in year two, this 25 kwacha is going to, let's see, the selling price is increasing by what percentage? 8%. So starting from year two, it's starting to increase by 8%. Okay. So in year one, the selling price is 25 kwacha. In year two, this selling price is going to increase by 8%. Okay, so colleagues, you can do 8% of 25 kwacha, then add that value to 25, or you can just do it like this. 25 kwacha multiplied by 1.08. Okay, this 1.08 is just representing an 8% increment. Okay, so 25 times 1.08, you're going to get 27 kwacha. Okay. This 27 kwacha again is going to grow by 8%. Okay, so you can also, so 27 multiplied by 1.08. 27 multiplied by 1.08. Colleagues, what are we getting? 7 multiplied by 1.08. Calculators, I hope we all came with calculators. Okay, this is not a topic to to listen in. Hmm. Yes. The other way you could have done it, colleagues, would have just said 25 multiplied by 1.08 to the power 2. Okay. 25 multiplied by 1.08 to the power 2. So, colleagues, which one are we comfortable with? This format or the rolling format where the next amount multiplied by 1.08? Which one are we comfortable with? So that I highlight it. Okay, 25 by 1. Okay. So this 2, because it's the second year when the growth rate is being applied. Okay. So actually, let me use this other one because yeah, people will start getting confused. Sir, year three, how come you're using power two? Year four, you're using power three. Colleagues, the reason why that is happening is because the growth is starting in year two. Okay. So let me just to make life easy, let me just first put it like this. Okay, the simple format. In year three, this 27 kwacha is going to grow by I think 8%. You get 29.16. Okay. Then in year four, this 29.16 is going to grow by 8%. 29.16 multiplied by 1.08, what are we getting? 29.16 multiplied by 1.08. Where have I left the calculator? Yes, that 1.49. Yes. So I think this way will make life easy for everybody. Okay. Yes. Any questions? So that's the selling price. Year one, 25 kwacha. Year two, it grows by 8%, 27 kwacha. Year three, it grows by another 8%, 29.16 kwacha. Year four, it grows by another 8%, 31.49. Are we okay with this? These are just percent increments. Yes. Good evening. In the question, it told us the selling price is going to be increasing by 8% starting from year two. Okay. In the question, it has mentioned the selling price is going to be increasing by 8%. So the selling price is 25 kwacha. Okay. In year two, it increases by 8%. That's why I'm multiplying by this 1.08. Okay. That 1.08 just represents an 8% increment. Okay. So in year two, 25 multiplied by 1.08, you get 27 kwacha. That is the selling price in year two, 27 kwacha. Year three, this 27 kwacha is going to increase by 8%. So the selling price in year three, 29.16. Is that okay, madam? We are just making adjustments for the selling price. Mm, mm. Yes, yes, I can get you. Yes, sir. That's a very sharp observation. Yes. It's like we're finding the future value here. Future value PV1 plus R. Okay. Yes. Any other questions? So remember, colleagues, these adjustments, you usually see them. Okay. It's just this, just telling us every year our selling price will be increasing by 8%. Okay. Yes. Any questions before I go now to the variable expenses, which will increase by 6%? Okay, the variable expenses are going to increase by uh, 6%. So could you mute your mic? Could you mute your mic? Hello, hello, can you get me? Okay. Yes, you can. Yes. So yes. So first part, they were making the adjustments for the selling price, 8%. Okay. Mhm. Okay, we now go to the variable costs. Okay, the variable costs. Okay, they told us these are going to be increasing at 6%. Okay. Yes. So year one, it is 6 kwacha, the variable cost. Year two, this 6 kwacha increases by 6%, which is let's get our calculator so that we confirm, okay? So that those people who are just memorizing numbers shouldn't memorize the wrong one. Yes, so 6 times 1.06, are we all getting 6.36? Okay, that's good. Year two, okay, this 6 kwacha is going to, oh, wait, we started from year two, right? Yeah. Year three, this 6.36 is going to grow by 6%. So 6.36 multiplied by 1.06. Okay. This is the variable cost for year three. Year four, 6.74 increases by 6%. Uh-huh. Yes, question B, part B. Yes, well, we are getting the cash flows for the investment appraisal. Yes. Year four, 6.74 increases by 6%. Are we getting 7.15? All right. Any questions, colleagues? Consumer friendly? Mm-mm, sir, just two decimal places is okay. Okay, just yes. Yes. Do not worry, colleagues. It's okay, all right? So long as we're in the range, okay? We're in the range. Any questions? So I've seen this first part is very easy, okay? It's just percent changes, right? Then for the variable overheads, also them they're going to be increasing by 6%, okay? Okay. So yes, year one, the variable overhead is 2 kwacha. Okay. Year two, this overhead increases by 6%. Okay. So uh-huh. I was going down, sir. I'm going down like this. Maybe mean up. Maybe like okay. Put this in order so that it looks nice. Yes. So the variable overheads they are increasing by 6%. So um in year two, this 2 kwacha increased by 6%. Uh-huh. Please go ahead. Oh, we're doing it here in the second method. We're doing it in the second method. Okay. Have you seen here for the previous variable cost? Since in year two, that's the first increment, so we're raising it to the power one because the percent increments start in year two. That's why in year two, we're raising it to the power one. In year three, we're raising it to the power two. Okay. In year four, to the power three. Is that okay, Madam Sylvia? Uh-huh. Yes. Yes. Well, you're welcome. You're welcome. I hope colleagues, you have all seen that. Okay. It's up to you to choose which method you prefer. Okay. Yes. because the growth starts. Yes, the growth starts in year two, madam. Yes, yes, because yes, yes. No, what do you mean where the percentage is being affected? Or when the percent starts occurring, oh yes, 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 yes. Since it's yes, yes. Okay, so the variable overheads they're also growing at 6%. Okay. Uh-huh. So in year two, year one, it's two kwacha the variable overhead per unit. These are all per unit costs, okay, colleagues? Two kwacha per unit. In year two, it grows by 6%. Okay, it becomes two kwacha 12 ngwe. Okay. In year three, this two kwacha 12 ngwe increases by 6%. You get two kwacha 25 ngwe. Okay. Those with calculators confirm these figures. Right. Then in year four, this two kwacha 25 ngwe is growing by 6%. Yes. Any questions before we calculate the depreciation expense? No, it's a test, an actual test. Mm. Huh. It's an actual test question, sir. That's why I'm saying that in the exam, if you see this question, it's the only question you're doing in the exam, and maybe multiple choice. Okay. Because by the time you're done with this question, you won't have any time for other questions. But is it consumer friendly, Mr. Chimodia? Okay, these are just percent changes here. Okay, they've just um, do not worry, sir. Okay, do not worry, sir. Okay, because the way it is the the there will be those who understand this question when we do it here. Then when we do a similar question next time, more people understand. Then we do another question, then everyone will understand. Okay, colleagues. But I know if you're not going to attempt this question in the exam, okay, just understand the process that's going on, okay, because in cost accounting, you'll be making a marginal costing profit statement. Okay, yes, yes, marginal costing. No, it's not. No, it's not under marginal costing, madam. It's just that to get the cash flows to discount, we need to get the profits that we're going to expect from this project. So that's why we're using a marginal costing profit statement. Okay. Yes. Okay. So depreciation. Remember depreciation cost. Hey, why did I put the reducing balance method? Okay, just in case they ever bring where you have to use the reducing balance method, you can use this formula. Okay, but the formula that we're using for the depreciation is this one here. This I'll put it somewhere else. Yes. So depreciation is cost minus scrap value over the number of years. Colleagues, what is the scrap value? What is the definition of scrap value? So remember, even when we're going to do you see, yeah, that's correct, sir. That is correct. Scrap value, how much the machine is worth after its useful life. So the cost, colleagues, of this machine is 7.1 million. The scrap value is 3 million. Useful life, 4 years. Okay. So with these type of questions, what I advise, as you read through them, underline with your pen and jot down and say, okay, data collected, so that once you start solving, you know where to get the figures from. Okay, colleagues? Yes. You underline, yes. You underline because this you should see the Zika questions. They are they are paragraphs. So it's important to underline, colleagues. So the cost 7,100,000, scrap value 3 million, number of years 4 years. 7 million minus 3 million, 4,100,000. Okay, 4,100,000 divided by 4, 1,025,000. Are we okay with this, colleagues? Yes, verify, colleagues. Now, if you don't know how to make a marginal, let's say the day for the exam comes and you don't know how to make a marginal costing profit statement, just remember you're just deducting the sales revenue from the variable costs and the fixed costs. Okay, colleagues? You are just deducting the variable costs and the fixed costs from the sales revenue. So it shouldn't be complicated, okay, colleagues? Yes. Like this? Okay. You've got 1,025,000. Okay. All right, colleagues. Now we can make this profit statement. Okay. Since the machine's useful life is for 4 years, all right. So you have to. That's why this type of questions. Okay, you have to get for 4 years the profits for 4 years. Imagine that. Okay. So first things first, we need to get our sales revenue. Okay. Our sales revenue. Okay. Sales revenue, you're just going to multiply the selling price per unit times the number of units sold. Do not multiply. If you see production and sales of the units do not multiply by production, you'll get it wrong. Okay. So here the company expects to produce and sell 300,000 units per year. So what they're producing and what they're selling is the same. Now, just in case in a question, what is being produced and what is being sold are different, for the sales revenue, you focus on the units sold. Then for the costs, if you focus on the units produced. So 300,000 per units, 300,000 units per year. If you see this, the number of units sold and the number of units produced are different. For sales revenue, focus on the units sold. Okay. Sales revenue, focus on units sold. Okay. Then the costs, focus on the units produced. Is that okay, sir? Okay. Yes. So year one, 25 kwacha per unit. We're selling 300,000 units. So sales revenue, 7,500,000. Okay. Let me just do year one so that you know what happens in year two, year three, and year four. Okay. Uh, After we get the sales revenue, okay, we need to deduct our variable costs. Okay, colleagues? We have to deduct our variable costs. Okay. So we're going to say less. Okay, these variable costs. Remember, variable cost is 6 kwacha per unit in year one. So 6 kwacha per unit multiplied by 300,000 units that have been produced. Our variable cost is 1,800,000. Our variable overheads, 2 kwacha per unit multiplied by 300,000 units that have been produced, 600,000. Okay. So your contribution is sales minus variable costs. Okay, sales minus variable costs. Okay, so what you can do, if you want, you can total up these variable costs. Okay, you total them up and subtract from 7,500,000. Or let's get our calculators. You can just say 7,500,000 minus 1,800,000 minus 600,000. What do we get? 7,500,000 minus 1,800,000 minus 600,000. What do we get? 7,500,000 minus 1,800,000 minus 600,000. Yes, just focus on the numbers highlighted in yellow. Then just excuse me for 2 minutes. Okay. Just excuse. Okay, just excuse me. I'm coming. 5,100,000. Yes, you can be, yes, become a professor. Yeah. Yes. Yes, we got 5,100,000, right? Any questions, colleagues? Yeah. Uh-huh. That scrap value, it will be added to the cash inflows of year four. That's all. That's all that they're saying there. Yes, it will need to be included in that year four figure. That year four figure that you're going to be discounting, that 3 million is going to be included there. This figure in year four, which will be discounting, okay, this 1,651,900 will include this scrap value. Have you seen here? Scrap value. Oh, you add, I think I added them and we get what's this? 3 million plus. We're going to add it as you're going to see, colleagues. We're going to add it. That's scrap value. So that the figure for year four that you'll be discounting is going to include that scrap value. Yes. Any other questions? This 3 million, the scrap value, okay, is going to be included in the figure for year four that you'll be discounting. Okay. This 3 million here, this scrap value, yes, it will be included in the figure for year four that you'll be discounting. So you're going to add it with the cash flows for year four. Is that okay, colleagues? Okay. Um, Fixed costs 1,650,000. Okay, 1,650,000. Okay. And then you've also got depreciation, which is another fixed cost. Okay. You've got two fixed costs here. These ones, which are 1,650,000, and you've got depreciation. Okay. This 1 million here, where is it? Yes. Annual incremental fixed costs of 1.65 million. Okay. This fixed cost and depreciation, we're going to subtract. So you're going to say 5,100,000 minus 1,650,000 minus depreciation 1,025,000. Let's get our calculators. Let's see if we're getting 2,425,000. Okay. Then tax. Remember, they've told us corporate tax is 30%. So you're going to get 30% of this 2,425,000. Are we getting 727,500? We're getting the tax. Okay. Okay. So 2,425,000 minus 727,500, we get 1,697,500. Okay. So this is the cash flow that we need to discount for year one. Any questions? Mm-hmm. Yes. Is that okay, Mr. Chimonia? You have to do it for 4 years. Okay. Yes. Any questions, colleagues? Consumer friendly? Okay. Where are we having issue? Year two. Yes. So can I leave you as a class? Mm-hmm. What? Mhm. This minus this to give you this. Okay, let's do year two. I wanted to leave you to swim and try year two, three, and four, but let's do year two. Okay. Year two, sales revenue. Yeah, sales revenue. The selling price, 27 kwacha, 300,000 units. Sales revenue, 8,100,000. Less the variable costs. Variable costs, 6.36 per unit multiplied by 300,000, you get 1,908,000. Variable overhead, 2.12 multiplied by 300,000. Okay. Yes, go ahead, sir. Uh, yes. Uh-huh. 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 Yes. Any other questions? Okay. Do not make Dr. Kawe angry this year because he'll bring this in the exam. Okay. Make him feel good so that this comes for the deferred students. Okay? Not necessarily. What Another way you can do it, you can just total up all the variable costs, you subtract them from sales revenue. Total up all the fixed costs, subtract them from the contribution, then get the tax and whatever. Okay. 'Yes. Yes. But in the exam, it's too long. This is by the time you're here and they're saying 30 minutes, 5 minutes. Hmm, colleagues, imagine that you have started year two and let's say 5 minutes till the exam ends. What do you do, colleagues? If you remember, if it's a similar question, just put the answers you memorized, okay? Just put the answers you memorized in those 5 minutes, so you just get the marks. Don't worry about the workings, okay? 40 marks. If it carries less, don't, then it's not even worth attempting. Okay? Because if you see it at 20 marks, just don't even waste your time attempting. Don't. Unless 40 and above, that's when you attempt it. Yes. Contribution, colleagues. 8,100,000 minus 1,908,000 minus 636,000. What do we get? 5,556,000. Okay. Any questions? This is the contribution. Okay. Then we subtract the fixed costs. Okay. So since they said annual incremental fixed costs. Okay. So in year two, you say 1,650,000 plus 1,650,000, you get 3,300,000. Any questions? Depreciation is the same, 1,025,000. 5,556,000 minus 3,300,000 minus 1,025,000, you get 1,231,000. Okay. Tax, 30% of this amount is 369,000. So you're going to add this amount. You subtract that amount with this amount to get 861,700. This is the cash flow for year 2 that you'll be discounting. Okay. So colleagues, can we resume at 22 hours? Can we resume at 22 hours so that we finish this question? Is that okay?